Okay, so let's take a look at the review handout I posted for you guys to work through yesterday. Actually, I should say that I posted on April 24th for you guys to work through. It had 4 problems, and it's not meant to be an in-depth review, just kind of a high-level review of content from chapters 11 and chapters 12. All right. So let's take a look at the first question. Samuel Company invest in a new piece of equipment costing $50,000. The equipment is expected to yield the following amounts per year for the equipment's 6-year useful life. All right, so it gives you revenues, expenses, depreciation, and then income provided from the equipment, and the cost of capital. All right, and the question is, what is the net present value of the investment in this equipment? All right. So we want to look at cash flows. All right. So, and we can think net. So the 60,000 is an inflow. The cash expense of 32 is an outflow. So net. Those amounts to 28, and it is a 6-year useful life for the equipment. All right, and cost of capital is 10%. So let us look at our tables. All right, and this is an annual net. So we want to look at table 14B2 for 10% for 6 periods. All right, and we get 4.35526. All right. Oops. All right. Over here. All right. So present value of net cash flows is revenue less the expenses times our factor, which we identified as 4.35526. All right. Investment is 50,000. All right, and I'm going to go ahead and show the investment as a negative. All right. So net present value of this investment in equipment, $71,947.28, and that is positive. All right. So this would add to the bottom line. All right. To ask for internal rate of return. I guess I should label this. To ask for the internal rate of return. All right. So let's see what the problem gives us. Emerald Company is considering the purchase of a new machine for $41,000. The machine would generate annual cash flow of $10,000 for 6 years. At the end of 5 years, the machine would have no salvage value. The company's cost of capital is 8%. Company uses straight line depreciation. What is the internal rate of return to the nearest percent? All right. So we need to come up with the factor that we should look for. Let me see, how do our formula sheet designate this? All right, so we'll take the initial investment by the annual cash flows, $10,000. All right, and that's actually not dollars. $4.1. All right. So we need to look on our table for that factor for the corresponding time period. And we're going to go with 6 years. I know the problem referenced 5. I think that's a typo. So let's look at 6 years. And we are dealing with an annuity because the $10,000 is going to come at the end of each year. All right. So we're still on table B2, the annuity table. All right. So we're going to look for 4.1. Which works out to 12%. All right. So the IRR is roughly equal to 12%. All right. So let's look at the third question. An investment of $15,000 provides average net cash flows of $700 with zero salvage value. Depreciation is $25 per year. Calculate the accounting rate of return using the original investment. All right. Okay, so the thing to remember with accounting rate of return, it is income focused as opposed to cash flow focused, which means we cannot ignore depreciation. All right. So looking at our formula sheet, ARR, accounting rate of return. Average annual operating income divided by initial investment. All right. So we do have to take into account depreciation. All right, and again, that's not a dollar. That we want to think of that as a percentage. So let us format accordingly. Increase the decimals and 4.5%. All right, so that project, at least from an accounting perspective, returns 4.5%. All right. Question 4. A firm is considering a project with annual cash flow of $500,000. The project would have a 4-year life. The company uses a discount rate of 10%. What is the maximum amount the company could invest in the project and the project still be acceptable? All right. Okay. So really this is similar to net present value without the initial investment. So all we need to do is take the present value of future cash flows. And since you subtract out the initial investment anyway, pretty much anything smaller than the number we get is going to be, for the initial investment, would lead to an acceptable investment. Anything larger than that would lead to a negative net present value for an investment that would be unacceptable. So let's compute the present value net cash flows. $500,000 times. All right. 4-year life. So let's go back to our table. We are still dealing with an annuity because it says annual cash flow for 4 years. Company uses a discount rate of 10%. So 10%, 4 years, which is 3.16987. All right, which gives us $1,584,935. All right, so making sure that's the maximum amount the company could invest and the project still be acceptable is that number, because that would give you a net present value of 0 if the investment were that amount, which means that the project would return exactly 10%. Right? A positive net present value means it's returning more than 10%, and of course a negative net present value would mean that it's returning less than 10%. All right, so let's see if we can put this in plain English. All right, so that's the review handout. We've got a few days. Our final, our last exam is probably more appropriate. Will open on Wednesday, and from that point we'll have 48 hours to get that done. And so if you need anything between now and then, definitely feel free to reach out. And until then, I'm around.